start right now. So I'm recording now, and I'll be sending out a copy of this recording. So again, I'm Dean Jenkins, founder of followmetrades.com, and today's presentation is stock option basics. And I'm just surprised at how much interest there was in that topic. I kind of floated it out and said, well, I'll see if anybody's interested, and the interest was overwhelming. Had over 150 people subscribed for this webinar, so that's great. That's outstanding. I'm glad you're here. Thank you for taking the time. So again, we're going to cover stock option basics, and I'm going to get right into it. So I'm going to cover these 6 things tonight. Oh, before I get started, I was presenting at traderscoach.com last Wednesday, and I lost the internet connection, and I didn't even know it. And I spoke to a computer screen with nobody listening for like 15 minutes. So I've got another computer over on the side where I'm monitoring to make sure I'm still online. If I do drop for some reason, stay on the line because I got another backup internet connection I can switch over to. But yeah, that was awesome. These things keep us very humble, don't they? So I'm going to cover these 6 areas. I'm going to cover the basics of options, just some definitions and how they work. I'm going to talk a little bit about what I call the incredible power of options and the profit potential that they can give us. I'm going to go through the risks because there are some risks in options, and quite often we hear, warnings about options, and some of those warnings are legitimate. I'm going to talk about how to control that risk when you are trading options. We're going to go through an option chain. This is a list of different options, and just teach a little bit on that and show you the information that's there. And then I've got some suggested next steps that you can take. But first, of course, we always have a disclaimer. And that disclaimer is I am not a financial advisor, I'm not a CPA, and I don't know your personal situation. So I'm providing information that I believe is as reliable as possible, but it's intended for information and education only. I'm not giving you any specific trade advice. Okay, we got that out of the way. Let's jump right into this. So stock options, how do they work? So there's 2 basic types of options. There's calls and there's puts. And you probably heard those terms. So when you buy a call option, what you're buying, it's a contract. You're buying the right, but not the obligation. And that's really important, and I've underlined it there. You're buying the right, but not the obligation to purchase stock at a predetermined price at any time before the option expires. And if you're more graphic than you are, verbal or text, I'm going to have a little more graphic thing coming up here. Okay, but when you buy a put option, it's just the option. You have the right, again, underline, not the obligation to sell a stock at a predetermined price before the expiration date. So this option, it's a contract, and it's between 2 parties. The contract writer, and it's important that term kind of stick in your mind, and the contract buyer, because as a seller, you can later sell your contract. So I use the term writer. This is the person who's writing the contract. Okay, and the buyer, again, has a right, but not the obligation to exercise the contract, to act on it, and to buy or sell the shares. So they have a right, but not an obligation. Okay, the contract writer has an obligation. They have an obligation to sell the shares or to buy the shares if you exercise the contract as a buyer. Okay, big difference. And just a note, we're going to talk about American style options. So European style options are a little bit differently. The key difference is American options you can exercise at any time during the life of the option. European, you have to wait till the end. That's the main difference as I understand it. I only trade American style options. And again, type in questions as we go. I'm happy to field those and keep it real interactive. So call option basics. So let's just take a scenario here. Suppose you have reason to believe. Your analysis or you're reading about a company or you just like a company, whatever. You've got a reason to believe that the company stock's going to go up. Well, you could just go buy shares, right? You could just go buy shares in that company. Or you could buy a call option contract. Okay. So why would you consider buying a call option contract instead of just buying the shares? Let's look at an example here. So here's Apple. Everybody, or almost everybody, likes Apple, right? So here's the Apple daily stock chart as of October of last year. It's bobbling around here. It's had a bit of an uptrend, And now it's sitting here at about $100 at the end of October 2014. Now, if you have a reason, they're going to launch the next iPhone or, whatever they're going to do, you believe, I think Apple's going to go to $120 by the end of the year. You have some reason to believe that. Well, wouldn't it be cool? Wouldn't it be cool if you could buy it at $100 after it went to $120? You think it's going to go to 100, 120, it's sitting at 100. Wouldn't it be cool if you could buy it after it went up? Kind of raise your hand, give me a yes if you think that would be cool. Well, look, you're a genius. Apple did go to $120. That is awesome. That is awesome. Okay. And now, because you're a savvy options trader, you get to buy it at $100 per share. How's that possible? It's possible because you bought a call option contract. Back in October, you had a reason to believe that Apple was going to go up to $120. So you bought a call option contract with a strike price. So that's an important number, a strike price of 100. Okay, the strike price is the contracted price that you can buy the shares at, regardless of what the current price is. Okay, and since the stock went to 120, well, that's really good, isn't it? Now, of course, this isn't free, right? You have to buy the contract. You have to pay for that right to buy shares at $100 in the future. And the cost of that contract, what you're paying, is called the premium. So that's an important term. Premium is the cost to purchase the call option contract. It's the right to buy shares at a predetermined price. And that right does not last forever. It has an expiration date. And after that date, you don't have the rights anymore. They have expired and no longer exist. And if the price of the stock had not gone up, and if you didn't exercise your right, then your contract would have expired worthless. It would be worth $0 at the end of that time. So let's look at the other scenario, okay? Put option. And this is really just the reverse. It's just the reverse, right? So you have a reason to believe that a stock is going to go down. Again, you could sell short on shares of the stock, assuming that you're not trading in an IRA, because you cannot sell short in an IRA. I've got a whole presentation on that. Or you could buy a put option contract. Yes, you can buy put option contracts in an IRA. That's a really good thing. But why would you consider buying a put option instead of just shorting the shares? Well, it's really the same example, isn't it? So here, later on, this is this year, July of this year, this is Apple. And you're looking at it, you go, oh, it's in a downtrend here. It's trading at about 120. I think it's going to go down to 100 by the end of the summer, right? This is July. I think it's going down to 100, a pretty sharp drop. And wouldn't that be cool? Same thing, wouldn't it be cool if you could sell Apple stock at $120 after it went down to 100? I think so. And look, it happened, right? Once again, you are a genius, and there it is. And Apple's sitting down there below $100, well below it. And because you're a savvy options trader, you get to sell it now at $120 a share. Awesome. And it's the same thing. I won't go through the whole line here, but you bought a put contract, and you had the contracted right to sell Apple shares at $120. And you can exercise that, and the writer of the contract has to sell them to you at $120, even though it's sitting down there at 95. How cool is that? So again, it has an expiration date. That does not last forever. It expires, and if the stock didn't go the way you wanted, or if you haven't exercised it, it will expire worthless. And Kevin's asking, if you're on the losing end of a trade, can you be forced to own the stock? Great question, Kevin. Hold the thought, because we're going to get into the risks of options in just a minute, okay? So hold that thought. You're a good straight man. You're setting me up here, because that is the question, really, isn't it? Okay. So let's first look at the incredible power, right, and the profit potential that options provide. And that power, it can be described in one word. It's leverage. It's leverage. So let's think about this, this Apple call option, the first example I gave. And here's a note, this is important. Option contracts are for 100 shares per contract. So when you buy one contract, one call option contract for Apple or for any other stock or ETF, that's the right to buy or sell 100 shares of the stock at the agreed price. So in October 2014, we bought a call option contract. Remember, we thought, hey, it's at 100, it's going to 120. I'd like to buy it at 100. So we bought this. We bought it at what's called a strike price. That's the price we can buy the stock at if we choose. If we choose. We have the right, but not the obligation to buy the stock as a buyer. Okay. We have an expiration date. So we were back there in October. We thought by the end of the year. So we bought a contract with an expiration in January. That seemed like the right timing. Okay. And the premium, we paid $1,000. We paid $1,000 for the contract for the right to buy 100 shares of Apple at $100. Okay. So if we had just bought the shares in October 2014, it would have cost us 10 grand. 100 shares times $100 is $10,000. And it did go to $120, so that's a $20 gain per share. That's a $2,000 profit, a 20% gain. Well, that's pretty good. But look here, if we bought the, it's a typo, it should be the December or the January contract. We bought the January call option, strike price $100, cost us $1,000. We bought one contract. Okay, so we got a $1,000 investment, and we've got a $2,000 gain, right? Because we have this contract, we can just exercise the contract and buy Apple at 100 and sell it at the same instant at $120. Okay, $2,000 in gross profit. We had to spend $1,000 for the contract, so we made $1,000 in net profit. That's 100% gain. We put $100 at risk or $1,000 at risk. We made $1,000 in profit. 100% gain. That's leverage. And for $1,000, what you effectively did was you controlled or you profited from the price move of $10,000 worth of shares. So that's like 1 to 10. That's huge leverage. Put option example works in exactly the same way, just a mirror opposite of it down. Okay, so who's kind of excited about the leverage possibility of options? Give me a couple of whys there if you think that's exciting. Or maybe I'm just a geek and I get excited easily. Thanks for playing, John and Matt. Appreciate it. All right. So what's next here? If that's not good enough, if the fact that you can get this incredible leverage, like on that example, 1 to 10, right? You can have $1,000 on the table and control and get the profit from $10,000 for the Apple stock. Here's something even cooler than that. You don't have to actually exercise the contract. You don't have to actually buy or sell the shares. You just sell the contract. Once the Apple went up to $120, this contract that you own is very valuable, right? Back in October, you bought it. January 15th, strike price 100, call option for $1,000. Well, we're sitting here in December with Apple at $120. Your contract has an intrinsic value of $2,000, right? It's axiomatic. You get the chance to buy 100 shares. This contract gives whoever owns it the right to buy 100 shares at $100 and sell them at the market. So it's intrinsically worth $2,000. Okay, that's valuable. And you can just sell the contract. Contracts trade just like stocks do, similar. They have a bid, the ask, and a market maker, and you can sell them without ever taking possession of the actual shares. Okay, and I got a note here. Selling contracts that you own is different than writing contracts. Understand it, it's important. When you buy a contract, the term is buy to open. That's what you tell your broker. I want to buy to open, one Apple January strike price 100, right? Buy to open. When you sell the contracts that you own, you sell the close. That's the order you go. I want to sell the close, the position that I have. Okay, so that's pretty cool. Now Andrew's saying, okay, what about the risks? Yeah, There are risks, right? Let's talk about the risks of options because there are some. There's no free lunch on Wall Street, right? Nothing for free. So with leverage and potential really big gains, there's some risk. So let's talk first about the writers. The writers of options. These are the people who wrote the contract, and they are obligated to deliver the shares. So if I buy a call contract and I exercise it, right, and my call contract says I get to buy Apple at $100 a share and it's sitting at 120, the writer of the contract has to sell me shares, 100 shares at $100. The writers of contracts, for them, the risk is unlimited. Unlimited. How do you feel about unlimited risk? It would keep me awake at night, right? I would not like that term. Yeah, Matt. So Matt's asking, who are these writers? Owners of the shares? I think I got a couple coming up in a couple of points, but yeah, sometimes the people who own the shares and they want to try and make some money, right? They're going to hold the shares long term, so they're going to write option contracts against it and try and keep the premium. They're thinking it's going to go down maybe before this thing expires, and so you're going to give them $1,000, and they think it will expire worthless, and they get to keep your $1,000. Okay. So there are people who have the contracts and are writing, who have the shares and are writing contracts to try and make a little extra money off of them. And then there are people, those are called covered calls. And then there are people who are speculating who don't have the shares. They're writing contracts, and if they, if it goes against them, if you exercise, they would actually have to go buy them and deliver them. That's called a naked contract, and it's as potentially awkward as it sounds. Right. So why would they take unlimited risk? Yeah. Well, you have to ask them. And there's a lot of really complex option strategies. We're going to get into it just a little bit. Okay. So what's the risk to a buyer if you were to buy option contracts? People who have the right but not the obligation to buy or sell the shares. The risk only extends to the premium that we pay for the contract. We can lose up to 100% of the premium that we paid. So our example for Apple, in October we bought a January 15 strike 100 call option for $1,000. The absolute maximum amount of money we can lose is $1,000. And again, we have the right, not the obligation to act on that contract. So we don't have to do anything. So Kevin's asking, if you're on the losing end of a trade, can you be forced to own the stock? Not as a buyer of a contract. The only thing at risk is the $1,000 you paid for it. You can't be forced to do anything. So that's good. If you are the writer of a contract and the buyer exercises it, yes, you must deliver the shares, okay, regardless of where they're at the market. Okay, so there's a big difference there. Okay. If you thought the price was going to go up and then it went down and you did nothing, the contract would expire worthless and you'd lose your $1,000. Now, you don't have to let it expire worthless. Even if the stock is moving against you, you can sell your contract before it expires, maybe for a loss, but you don't have to sit there and let it expire and lose the full amount of the premium. Again, there's an active market for option contracts, and you can simply sell it for less than you bought it for and take a small loss and move on. And this is an important point here, the last one. As an option contract gets closer to its expiration date, it has something called extrinsic value. I talked before about intrinsic value. So if you have a $100 call option and the stock is at 120, it's got intrinsic value of $20, right? It's absolutely worth that. Now, if the stock has upward momentum, the premium actually may be higher than $20 because there's expectation in the market that it's going to go up. It's got, a high delta, or it's got high volatility. All right, that portion, the extrinsic value of the contract, drops off very rapidly toward the expiration date, because there's little time left. There's little time left for anything to happen, right? That's called price decay, and it's another risk you have to pay attention to if you're the owner of a contract. So if it's going against you, you may want to get out of it sooner before any price decay sets in or before it accelerates, okay? Continuing on with the risks of options. So there are two options for writers of options, right? These are the people who are obligated to deliver shares. And we touched on this, right? There's covered, meaning they are writing contracts against shares they already have, or they are naked, means they do not have the shares. And if you exercise your option as a buyer, they have to go buy them at the current market price. And, in our example here, you bought if you bought a January $100 strike call, and the price went to 120, and you exercised it, the option writer would have to go buy shares at $120 and sell it to you for $100. Ouch. And what if something really dramatic happened and the stock went up to $200? Well, they still got to go buy them at 200 and sell it to you at 100, right? That's called unlimited risk. And particularly with put contracts, people are writing naked put contracts. Bad news come out in a company's stock and tumble, and they're on the hook to buy them at the strike price. I'm not really interested in that. Okay, so that's for writers. For buyers, one of the big risks is that the contract has a deadline. It's got an expiration date, and if the thing doesn't go your way, by the expiration date, your contract could be worth $0. But again, that risk only extends to the premium you pay. You can only lose 100% of the premium that you paid for the contract. You can't lose any more than that. You're not on the hook for any more than what you already paid. And you don't have to let it expire worthless. You can sell it before it expires, maybe for a smaller loss, but you don't have to lose the full amount. Kevin, why would you want to be a writer? So some people, some hedge funds, individual investors, they believe that's a good strategy, and they also do them as part of complex multi-leg option strategies where they are writing a contract, but they're buying an opposing contract to protect them a few strike prices away, so that if it really goes bad against them, the one they bought is protecting the one that they sold. There's all kinds of super complicated option strategies. I'm going to talk about what I recommend here in a little bit. And for hedging, that's right. So if you have a position and you don't want to take a loss if it goes down or whatever, you can use option strategies to protect your position. That's called hedging. Those are pretty advanced topics, and you really, really have to understand them before you try and do it. So how do you control risk when you're trading options? So one obvious risk, and it sounds like it's coming across with some of the questions here, one obvious step you can take is not to write option contracts, right? Remember these words: unlimited risk. These are words that make me lose sleep. Okay, so there are advanced option strategies like I talked about. There's called vertical spreads, and you hear about these winged creatures like butterflies and condors and iron condors. Those are all multi-leg option strategies where people are writing contracts and buying contracts at various levels. And some of those strategies are if they think the thing's going up, some if they think it's going down, and some if they think it's going to stay in the channel. These are very complex, very hard to understand, and you really got to go study them and know what you're doing. And I think you really need to understand what's the worst case in any of those strategies. What's the worst case, and what am I on the hook for? And I use TradeStation for my trading, right? And if even in Sim, right, if I go play around with some of those strategies and go to place the order, right, this little thing pops up and says unlimited risk, right? That's when I click cancel and move away. I don't like that. So I recommend and I follow a very simple option strategy. I only buy calls and I only buy puts. It's kind of boring, for all the exotic option people out there. They may sneer at that a little bit. It's safe. I understand it. I understand it absolutely. I buy a call. I have a thesis that the stock's going up. I know how much money I will lose if I'm wrong, and I know how much I'll make if I'm right. I buy a put, same thing. I know how much money I got on the table. I know what happens if I'm right. I know what happens if I'm wrong. I know the deadline. It's really, really simple. I use a 2% rule. Generally, I only spend 2% of my trading account on any one option trade. Remember, they can expire worthless, go to zero. So worst case, it goes to zero, it expires worthless. I've lost 2% of my trading account, right? That's not good. I'm not happy about that, but that's tolerable, right? Way more tolerable than, oh my goodness, I had a $100,000 account and I just lost $50,000, right? And in the blink of an eye, and I wasn't expecting that, right? Or even worse than that, I'm super aggressive and I went and bought $100,000 worth of naked put options, right? And now my broker is calling me every other 5 minutes, and that's just starting to get on your nerve because there's what's called a margin call. They said, hey, your account's negative and you gotta come up with a money partner right now, right? That'll get on your nerves. So you don't need to take that kind of extreme risk, right? Buy puts, buy calls, use 2%. Don't spend any more on it than you're willing to lose in the trade, okay? And again, I can sell it before it expires worthless. My loss is even less than 2%, okay? Yeah, can I explain buying a call versus selling a call? Yeah, we covered that earlier, and Kevin, maybe you look at the PDF and it'll come across, but when I buy the call, I have the right to buy stock at a predetermined price. That's it, at the strike price. I buy Apple with a $100 strike price and a January expiration. By January, I have the right to buy Apple at $100 a share, even if it goes up to 200. Okay. Selling a call, writing a call means I have to deliver those shares at the strike price. Okay. And maybe you're asking selling, right? I talked a little bit about that, right? When I buy an option contract, it's called buy to open. I can buy to open. I'm opening a position in this option contract. When I want to get rid of it, I sell to close. I sell the position that I have. Okay, that's why we use the term writing. People who write contracts, right? They're the ones who are on the hook and are taking more risk. Okay, so buy to open, sell to close. Those are the terms for option buyers. Okay, glad you got that, man. All right, keep going. Controlling option risk. So options are derivatives, which means, any derivative, it derives its value from something else. In the case of stock options, the value is derived from the underlying asset, the stock. Right? This is an option to buy or sell the stock. The value comes from the stock itself, the underlying asset. Okay, so the primary analysis that you do before you buy an option, whether it's put or call, it takes place on the underlying asset, the thing that's valuable, the stock. And before you ever consider buying a call or a put option, I think you should determine at an absolute minimum an entry price, a stop price, a target price, and a time to target. If you don't have those numbers, you're flying a little bit blind, and then you're going to be caught up into emotional trading. But after those have your values, then you go look at the option chain and determine what's the right contract to buy. I've got a copy of the chart here, right? And anybody's watched my videos or my picks or anything, my charts are always marked up, right? What's the entry? Here it's $100. What's the stop? If my thesis about what the stock is going to do is wrong and it goes down to this level, that's when I'm going to sell to close my option contract before it goes to zero, right? I was like, okay, I was wrong. I'm going to take a small loss, right? And I've got a target. And I've also got a strategy to manage this thing along the way, okay? But I think that's an important way. You control your risk by, it is far less risk to only buy contracts, to use a 2% rule in how much you spend on any given trade. So if it does go against you, your loss is controlled. And then to have a game plan, right, about when you're in this trade based on the underlying stock. Okay, you can't analyze an option chart. You can put it on a chart and it's a messy looking thing, right? You analyze the stock underneath it and then you need to make your decision about the options. Is the strike price always the actual price of the underlying asset? It might be a little clearer to you, Diana, when we look at a chain here, right? The strike price is the price that you get to buy or sell it at. That's the contracted price, okay? strike prices are, you'll see, are all over the place. There's in the money and out of the money strike prices. I think we're getting there in a slide or two. Here we are at an option chain. All right. So here's the option chain for Apple. And this is like a non-expanded view. So this is just showing all the monthly contracts that are currently available. This is a screenshot from TradeStation's Option Station Pro. You can see here we got, January, February, March out through, we got some months out here in next year, and then it jumps to the January 17, January 18. Those are called long-term leaps, long-term options. Catch a question here. Do you ever sell based on how much the option contract is lost? Some say they're only willing to lose 40% of the option contract. Therefore, if it loses 40% of its value, sell the call or the put. That's from Samson. I base my decisions on the stock chart, Samson. I'm only in a position, and that if I lose 100%, it's not devastating. I don't want to lose 100%, right? But my decisions about either taking profit or cutting losses, those happen on the stock chart itself, not based on what's happening to the option price. Does that make sense? You may not agree, but maybe at least you would hopefully understand my answer. Okay. So here's the option chain for Apple. This is the non-expanded view, the contracted view, again, just showing the months. So all these months are available. And there is a ton of data on a option chain. So let's look at this. Now I'm going to try and use my handy Epic pen. So just let me know if you can see this. I hope it's coming across on GoToMeeting. Can you see this circle where I just circled around the last price of Apple stock? Okay, good. Okay, so ton of data here, but you can simplify it. So this is obviously for Apple. Here's the symbol. Here's Apple's last price. It closed Friday at the end of the session at 106.40. That was really good news because we have a Apple put contract in my stock picks right now. Okay, here's the strike price column. Oh, by the way, this is all April. So I expanded April. So these are April Apple contracts. They expire in April. And it's the third Friday. All of the monthly contracts expire on the third Friday. Let me go back a slide. I'll show you that. Okay, they're showing the January contract expires on the 15th, the February on the 19th, the March on the 18th, the April on the 15th. Somebody chose some time ago that the third Friday is when contracts expire. Okay, so here we are. This is the April option chain. Here's the strike prices. Okay, 65, 70, 75, 80. On this side are the puts. On this side are the calls. Okay, notice how this line between 105 and 110, how the shading changes, right? For the puts above this line, they're a little brighter. These are shaded. And for the calls, these are shaded up here and these are bolded down here. Anybody have a guess as to what this line demarcates on this option chain? In the money versus out of the money. Timothy, got it, dude. In the money versus out of the money. And this will make your head spin just a little bit, so let's make sure I get it right. So Apple closed at 106. Okay. A put option contract at 110, right? This is in the money. All of these from here down are in the money. That means that the price of the stock is less than the price of Apple for put contracts, because if it's 106, I can sell it for 110. That's already a profit, right? These are in the money. These call contracts over here are up here are all out of the money, because the right to sell Apple at $105 when it's sitting at 106 isn't that valuable. It's not valuable at all. Okay, so that's how you read an option chain. There's a lot of data here. Let me scrub a little bit of my scribbling off. Okay, these prices, bid and ask. I told you these trade just like, or very similar to stock shares, bid and ask. Okay, this is the price the sellers want, either people writing contract or people selling to close, and this is the current price that buyers are willing to pay. Right? It's an auction, just like stocks. Okay, so say you were evaluating this, right? Yet you thought, like I do, that Apple's going down to about 98, right? I think it's going down to about here, about 98. Well, it's always better, usually better, to buy in the money contracts. In the money contracts. And the reason is this number right here, delta. Delta is the amount that the price of this contract is going to change for a $1 change in the underlying asset. So like if we look down here, right, at the 125, this says 0.80. So if Apple moves $1, the premium of the contract is going to move 80 cents. And by the way, these prices, these price quotes, like see the 110 is price is, you know, the ask is 920. That's actually $920. The 920 is per share. Per share, and these buy you 100 shares. So that's $920 to buy one contract. Okay, Diana, can I explain what I mean by in money, out of the money again? Yeah, it does kind of make your head spin. So I'll go through it one more time. Okay, let's just take one example. Okay, let's look at this this strike price 110 contract right here. Okay, 110. Apple is currently at 106. If you have the right to sell Apple for $110 and it's sitting at 106.40, that is valuable, right? That contract has positive value. In fact, here's this column. I talked before about intrinsic and extrinsic value, right? This contract has an intrinsic value of exactly the difference between the strike price and the closing price, right? Closing price 106.40, strike price 110. The intrinsic value is $3.60. This contract is absolutely worth $3.60 per share because that's the difference between the strike price and the closing price. And it also has extrinsic value. This means the market believes, because of the volatility and stuff like that, that this thing could go much lower, right? So the premium that you pay is the sum of these two. You pay for the intrinsic and the extrinsic value, and they land, you know, here between the bid and the ask. Okay. So you can see this same contract 110, the call, right, has intrinsic value of 0, because with Apple sitting at 106.40, the right to buy it at $110 is not very valuable. In fact, it's not worth anything, right? Currently, but there is some extrinsic value, so there are some people who think it's going back up. Okay, this is recorded. You can go back over it again. All right, clear as mud. I hope that's a joke, Kevin. Okay, so that's some, you know, so learning how to choose the right contract and stuff, it's complex. And this was really meant to be a basic options course. I wanted to show you some stuff. If you didn't know it, answer some questions, all that. And hopefully you found the information that I've presented so far useful. Okay, I'm going to keep going now. All right, some suggested next steps that you can take. So if you feel comfortable, if you already knew this stuff coming in, or maybe I cleared up a few things for you, if you feel comfortable analyzing stock charts, choosing option contracts, go forth and trade. Give it a try, by all means. If you've never done it, consider testing it in Sim or your demo account first. If your brokerage or your platform has that, most do. Get really comfortable with placing the orders and managing trades and stuff like that. So do it. Second thing you can do is subscribe to my stock picking service. I think it's good. And I include option contract details on 70-80% of my picks. So if you're really, really intrigued in options, but maybe you're not comfortable picking them out yourself yet, you can follow my picks, and they've been doing real well. We actually really are in that Apple put. We got in at 110.98. It's down at 106.40, I think it was. We're already deep in some nice profit. We just closed Goldman Sachs, and we're in a couple others that are going down because I was bearish on the market, and we're doing really well. It's a lot of fun. And the third, if you want to learn more about options, stay tuned, because I'm announcing a new, more detailed stock option trading course that I'm going to launch, and you're the first ones to hear about it here today. So the stock pick subscription, just give a little detail on that. So here at the bottom, you can see my record. 2013, the account grew 57.3%. 2014, it was 37, and this year to date, 27.11%. Been a tougher year. The market was channeling, turning over and heading down. So pretty proud of those results. I publish 1 to 2 stock picks per week. These are ones I'm buying on my own account with my own money. I have option contract details on about 70-80%. I give updates every week. I give a narrative on how the trade's playing out. I tell you when we're moving our stops, when we're going to sell for profit and lock in profit, lower risk. And I send midweek updates if something's going on. And if you, as a subscriber, when you sign up, you can get a free one-on-one consultation. We get on the phone and just answer any questions you have, or provide some training. And I just asked my subscribers, to send me some testimonials, and I was really blown away. I had like 6 people send me emails. I was expecting a sentence or two, and a couple of them wrote like a page, just talking about how much they liked the service and the updates and the training and stuff. So I was really pleased. Okay, here's the details you get. This is just a snapshot of the web page. Here's Apple, right? I show you the sell price range. We're going to sell at the stop loss price. Remember I said we always want to have a stop loss price and price target. There's a little calculator to help you figure out how to follow my risk control guidelines, and how many shares to actually sell or buy. And then here's the option contract details. So you're getting a freebie here in this if you're not a subscriber. So we're selling the April 2016 put, strike price 110, no more than 825 per contract. And I think it's already out of the buy range anyway, the sell range. But that one's doing super well. And so if you would like to sign up, if you're interested in that, there's also a 10-day money back guarantee, so it's pretty low risk. You can give it a shot. Sign up, really get a feel for it, and if you like it, stay with it. If you don't, you just cancel your subscription. Within 10 days, I will give you your money back. And after that, it's month to month. You can quit at any time. So here comes a link for my stock pick service if you're interested in that. Again, that 23% discount for people at the webinar. It's normally $97 a month. And and I'm giving it to you for $77 if you subscribe now. Okay. And then the other thing I announced was a options course. So I'm gonna be producing a new options course. I've got the material together. I just really have to finalize it. What you get in that course, it's gonna have 4 hours of teaching videos. So me on camera and going through stuff like this, 4 hours of in-depth teaching. I'm gonna make it as clear and as simple as I can. So there's some reading materials on theory and strategies. You have printable worksheets where you can actually practice and work through this stuff, apply the concepts. Email support, you can email me anytime with questions. And there will be 6 weeks. So if you buy this course, 6 weeks of weekly webinars where you can attend live. I'll teach, I'll answer questions. And if you're not available, you can watch the recorded version. And you get 1 stock option pick from my subscriptions every week. And I'll talk about why I'm taking it, how we're managing it, what my rationale was. In this course, you're going to learn how to choose the right option contract, what all those Greek things mean, how to use them to your advantage, how to place and manage option contract orders, some advanced risk management strategies so you can take actually larger positions than 2% and still only have 2% at risk, and a lot more. So I'm excited about this, and it's coming out. I'm going to release it on January 15th of the next month, and it's going to release at $497 for the course. And for webinar attendees, you're hearing about it first. If you pre-order it right now, you get a 50% discount, so you can get it right now for $248 if you're interested in that. Again, you pay now, and the course will be out in less than a month. And the link for that is right here. Multitasking. Boom, it's on its way. Okay, go back to a couple of questions here. Kevin's asking, John, how many months does a 77 rate last for? If you sign up at $77, you're good for life, even when I raise the prices, which I probably will, because we're doing pretty good here, John. So yeah, whatever rate you subscribe at, you get that rate for life, for as long as you are subscribed. Kevin's asking, do you day trade options or weekly? I don't day trade options. I take my positions based on a daily chart, and I'm in the positions anywhere from 1 week. Average is about 3 to 4. Probably the longest is about 6. So that's a typical trade. I'm not, I've day traded futures and stuff like that. I still do that occasionally, but options, I like to take them a little bit longer. There's a pretty big spread often on the bid and the ask, and you can even be right and lose money, and I hate being right and losing money. I don't like losing money anyway. So that's a long answer to a short question. Will the stock option pick be one of the 2 you roll out weekly to your stock pick subscribers at Samson? Maybe. Or I might find one that's really, really good for teaching for the options course. So it actually could be a different one. And there's some weeks where I haven't had any option picks, and so I would have to come up with a new one. And I've always got some on my radar screen. I've always got good picks ready to go. So not 100% of the time, Samson. That's the short answer there, right? Okay. That's really the end of the presentation. Thank you. I'll keep answering questions. I'll stay on as long as you guys have questions. So, John, how do you decide between buying options versus buying stocks outright? That's a pretty easy decision for me, John. If there's an active option market, I would prefer to buy the options. And so not all stocks have options, or they don't have deep option markets. If we go back and look at this chain real quick, one of the things, you learn this in the course, look over on the side where it says open interest. This is the volume that's being traded. And sometimes you'll look at a smaller cap stock or one that just doesn't trade in volume, and it'll say 3, 0, right? That's pretty hard to trade if there's no volume in the market. So if there is an active option contract market, I would rather trade with an option because I tie up less capital. And I have more capital available for other trades that come along. Yeah, Robert, hey, you're welcome very much. Kevin, wouldn't want to own the stocks these days. Well, there's stocks that are going to go up when the market goes down. That's for sure. Just scanning to make sure I answered all the questions. Yeah, I think I've pretty well covered it. Do we need volatility in the market to have opportunities, and is volume a part of that? Volatility is better. What the best is a clear trend. We've been in a bull trend in the market. We were in a bull trend for 6 years. That's why my profit was so good in 2013. Market was in a clear trend. It was just moving, right? So, when the market is trending hard, it's a lot easier to make money. And I think we're going to have a pretty hard downtrend this year. So I think we're going to have some good opportunities for profit. The worst thing for, a stock picker like me is a is a channeling market like we had from March to July, where it just bobbles back and forth and does nothing. That was no fun. All right, any other questions? Okay, well, I will send out, everybody will get a copy of the recording, those links again, and I really appreciate you attending. Timothy's asking, how long are the prices good for? This is Saturday. The stock pick thing, the stock pick subscription, Sunday midnight. Sunday midnight it's good for. The course pre-sale, I'm going to make that till till Christmas. That'll be valid till Christmas, and after that, people will, sign up for full price, man. All right. Thanks, Kevin. I'm glad it was helpful. Thank you, Andrew. John, oh, I appreciate that. Appreciate that. Diana, thank you. Matt, thank you. Great to have you all here. I really appreciate you guys showing up on a Saturday afternoon. This is more fun than Christmas shopping for me, that's for sure. Okay, gonna sign off now. And again, you guys will get the recording and those links again too. All right, take care and have a great Christmas, everybody. I really hope that for you and your families, your friends, you have a wonderful Christmas time and holiday season. All right, bye.